Today we're going to talk about our portfolios, reflect on what they look like and why they look like the way they do, and then how it's gone.
So I break my portfolio into a core and satellite.
Yep.
You know, practice what we preach.
Yeah. Put our money where our mouth is.
That's it. Now, in theory, I have an 80-20 split in how I invest at the moment.
Yep.
However, in reality, my portfolio doesn't reflect that at the moment. So my core portfolio is made up of 4 ETFs. So I've got exposure to the US through GGUS, which is a leveraged index fund. I've got exposure to Australia through GEAR, GEAR, which is a leveraged Australian fund. Then I have Asian exposure, VAE, Vanguard Asia X Japan, and a European ETF, which is VEQ, another Vanguard ETF. Those are my 4, and I dollar cost average into them every month at the moment, and I'm super happy with that. Automated, end-to-end process, don't have to think about it. Then I have 2 thematic ETFs, Semiconductor ETF, SEMI, Global X, and ATEC, which is the Australian Technology ETF, tracks the Australian Technology Index, and that is a BetaShares ETF. Those 6 ETFs make up 67% of my portfolio at the moment. So that's the, I guess, ETF and thematic exposure. My next largest holding, Ren, would you be surprised, is actually Bitcoin.
I wouldn't be surprised.
Oh, really? It's not something that I would recommend having a position that large, I would say. Like, my original thinking with cryptocurrency was to have a position size that I would be okay to go to zero on because of the sheer speed at which Bitcoin can move and can go to not zero, but it can fall pretty quickly. I would be pretty annoyed if I lost 14% of my portfolio at the moment, but it's just because this position has run so hard that it's fast taking up a larger and larger portion of my portfolio. There's probably an argument that I should try and rebalance that at some point, but with Bitcoin in another run at the moment, what do they say? Don't cut your winners. So I'm not going to cut it. I then have 6 individual stocks, Berkshire Hathaway, Warren Buffett's holding company, Eli Lilly, Supermicro, Transmedics, which we've spoken about on the show recently, a little bit of Alphabet, I have sold down most of it, and Macquarie Bank. So pretty concentrated individual stocks. And then for my small cap exposure, I have given about 8% to Fairlight Asset Management. So Fairlight Asset Management are a small cap fund manager here in Australia. They are a global small cap fund manager, and we've had them on the show a couple of times, Will and Nick, and I just love how they approach it, love their passion towards small caps, and they've done pretty well. So I have 8% in small caps. Then I have a bit of cash on the side sitting in my offset account. So I guess to wrap that up, 67% in ETFs, 14% in Bitcoin, 11% in individual stocks, and 8% in small caps or in active management.
Nice.
So that's the construction.
I guess the big question is, how has it actually gone?
19.95% total return for the past 12 months.
And that's across everything.
Everything.
What about at an individual level? Like, has your, like, the theory around your satellite portfolio is it should outperform your core.
Yep.
And if it doesn't, then you should just be 100% core.
Yes.
Has your satellite outperformed?
So my satellite ETFs have outperformed. ATEC was up 30% in the financial year FY25, so that outperformed.
Okay.
Bitcoin up 73%.
Yep.
So it's outperformed. And the best performing stock in there was up 65%.
So those are some of the winners.
Yeah.
I noticed that they're probably your biggest winners. No losers in your satellite portfolio?
Well, the satellite portfolio is pretty concentrated, Ren. And the only loser in there at the moment is the Alphabet position, down 6%.
Nice. Not bad.
For the last 12 months. I'm pretty happy with it. I think I would look at it and say that I probably could do a little more in the individual space, but the way that I allocate at the moment, most of the money that I am actively investing is going into the core ETFs, is going into the leveraged. You know, it was a pretty interesting experience. I've been through 2 or 3 pretty significant drawdowns with leverage. I've been through COVID, I've been through the 22 and also now Liberation Day. And I would warn anyone who's just started investing and anyone listening that thinks it is a good idea. I do believe long term, but you certainly have to be very wary of the speed at which they can fall.
Yeah.
Like it completely destroys your portfolio. But if you look at how they've rebounded since, like obviously markets are at record highs. If you'd panicked and tried to sell, like all of the leverage products are now absolutely booming. And it's just, something to be wary of. I'm just cautious of people tuning in for the first time.
You know, your majority of assets are in your core. Those core ETFs are market cap weighted index tracking ETFs. And what that means is it's not trying to make active decisions on we're going to buy and sell particular companies. It's just we rank companies from largest to smallest in a market, and that's what we own. And then they give you a low cost way to own them all in one trade.
Yeah.
And so that gives you the market average return. Obviously, then you have two that have leverage, so they amplify the returns and the losses a little bit. And then your satellite holdings, you don't need to be incredibly diversified in your satellite holdings because your core is incredibly diversified.
Yeah.
So you just own a few stocks and some crypto and an active manager that you believe in.
Yes. Yeah.
Nice. And over the past 5 years, you've done almost 29% per annum. So you'd take that.
I would take that. Absolutely take that.
Yeah.
Yeah.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.